This video overviews the discussion questions, review questions with Chapter 3. The very first question asks, explain the different purposes of the fund-based and government-wide financial statements of state and local government and primary differences between fund-based and government-wide operating statements. Again, recall from the prior chapter with fund basis of accounting is the accrual basis of accounting, a modified accrual basis of accounting, and the focus is really on the kind of the short-term immediate solvency of the fund ability to meet its obligations. So the modified accrual basis of accounting is much closer in spirit fundamentally to the cash basis of accounting. The government-wide financial statements are prepared on the accrual basis of accounting that you should all be very much used to from your traditional accounting classes. Reading from page 69 of the textbook, again, the third edition of Record All, fund-based financial statements are intended to provide detailed financial information about the governmental business type and fiduciary activities of the primary government. To meet users' broader information needs about the government as a whole, the Gatsby reporting model also required management discussion and analysis in two government-wide financial statements. So the idea here is that fund accounting is based on very much on the focus of a particular fund, which is typically dedicated to either overall general government operations, which would be the general fund, or debt service, or certain fiduciary activities that are very focused on that one area. Government-wide financial statements are meant to provide a broad view of the of the government as a whole. Of course, the main difference between the operating statements of the government-wide financial statements and the fund-based financial statements, the government-wide financial statements are much broader in scope. They incorporate all funds that the government has, consolidates them into one broad statement, breaks them up by functions, program, expenses, revenues. Fund-based financial statements operating statement only focuses on a particular fund. Of course, you talk about revenues, expenditures for the government one. Revenues and expenses for government-wide financial statements. For fund-based financial statements, talk about revenues and expenditures, which then reconcile, or the difference between revenues and expenditures of the fund, augmented by other financing sources, other financing users, is the change in the fund balance. That's pretty much kind of the short explanation. Question 3.2, discuss the different ways in which depreciation expense might be reported on the statement of activities. So if you go back again to page 72 of your textbook, it discusses with respect to government-wide statement of activities, talks about direct and indirect expenses. So if an expense could be allocated directly to a program or a function, then it's called a direct expense and needs to be incorporated as part of that program or function. It's useful in that sense to look at illustration 3.1 on page 71 in the textbook. Talks about, it shows exactly kind of like how the format of the government-wide financial statements, statement of activities is broken up. Gives you governmental activities a part of it, for instance, right? And then you can also have business activities part of it. But if you can, the bottom line is, if depreciation expense could be allocated to a particular activity or function, it needs to be allocated to it. So on page 72, it talks about, some readers might find it surprising that depreciation expense usually is reported as a direct expense. Depreciation expense for capital assets are clearly identified with a function or a program, should be included in the expenses of that function or program. Similarly, depreciation expense for infrastructure assets, such as roads and bridges, should be reported as a direct expense of a function responsible for the infrastructure assets. For example, public works or transportation. Depreciation expense for shared assets should be allocated to functions on an appropriate basis. However, assets that essentially benefit all functions, such as a city hall, may be reported as a separate line item on the same line item as a general government similar function. If the government opts to report unallocated depreciation expense as a separate line item, it should indicate that the amount reported in the line does not include depreciation expense reported as part of direct expense of functional programs. So typically, because depreciation relates to certain dedicated assets that are used as part of functions of programs, you put it as direct expense. If you cannot, for some reason, do that, if it's truly one shared asset that belongs to all functions of programs, it would be indirect. Question 3.3. Describe the format prescribed by GASB for government-wide financial statement of activities and how the format benefits financial statement users. Again, we've already kind of answered that question. Just go back to page 71 of your textbook. The statement of activities should be broken up by a program or function, governmental activities, business activities, fiduciary activities. And again, illustration 3.1 kind of shows us nicely. You have, first you have, one interesting element of it is unlike like your regular commercial GAAP, you first report expenses on the top of it. You can take a look. First column of the expenses given by a functional program, offset by, on the right, by program revenues. And then you have kind of, in the very last column will be your net expense or revenue, right, the difference. And that's when, for the part where revenues and expenses are directly allocated to functions of programs. In the bottom of it, you have general revenues, and most of the general revenues will be taxes, because taxes are levied against taxpayers, not for a particular function of program, generally speaking. The program revenues will be things like, unlike taxes, they will be things like fees that you charge for certain types of programs, and levies and so on. And then further down the line, kind of consistent with your commercial GAAP, you'll see special items, extraordinary items, things like that. The very last line item in the illustration for point 1 is the change in net position of the government, which is kind of like basically an equivalent of net income for the period, which you'd see in the commercial GAAP. Government doesn't make income, so we don't use the term. And net position beginning and ending, it's kind of like basically a retained earnings equivalent, change in retained earnings that you'd see in the commercial GAAP. All right. The next question asks, question 3.4, how does government define extraordinary special items? Compare the definitions, recognition of the statements, and FASB requirements. Well, with respect to FASB, it's an easy question because FASB stopped recently using the term extraordinary items. It's something that was there for a long time, but fairly recently, because of fair amount of abuse of the term by various companies, that classification no longer is available. In the classification for extraordinary items for the government, it follows the original FASB definition. On page 73, it says extraordinary items are defined as transactions or other events that are both unusual in nature and frequent in occurrence. So same language used to be used for FASB.
You've been reading for some time now, but you haven't stopped to practice.
It's no longer available for FASB. Special items as defined by GASB are items within management's control that may either unusual in nature and frequent in occurrence. So it's similar under FASB. Special items would be under FASB rules non-operating items, which would be would be reported below operating income in the income statement. So it's essentially very similar definition. Right, next question asks, question 3.5 asks us, explain the essential difference between revenues and other financing sources and expenditures and other financing uses. How each of these items report in the governmental fund statements of revenues, expenditures, and change in fund balances. All right, so now we're on to fund accounting. We moved on from government white financial statements. So revenues are essentially defined very similarly to your traditional revenues. However, the key on the GAAP, these are increases in assets. But the key distinction for the government, for the fund-based revenues, is that those have to be available to the government within either during financial statement period or shortly thereafter. So, for example, that will if you have a long-term receivable, which is not going to be collected within, say, 90 days after the end of the period, that would not be considered revenue for government fund accounting financial purposes. It would be under the government-wide financial statements, not for fund accounting. So page 75 gives a definition. Revenue is defined as increase in fund financial resources other than from financing sources such as interfund transfers or debt issue proceeds, right? So that basically kind of tells you that. Transfers into the fund and proceeds of debt issues and sales of government assets are examples of inflows classified as other financing sources of the fund. So, that kind of answers the question. So if you have money moved in from one fund to another fund, that's another finance source. If you issue debt, the proceeds from that debt would be considered other financing sources. If you sell assets, would be other financing sources. Expenditures, which are kind of like expenses, but not exactly the same thing, again, represent cost of purchased goods or service, whereas an expense represents cost of goods or service consumed or expired during the period. So here the key difference will be, again, essentially fund financial statements follow kind of like modified accrual, which is very similar to cash. So you won't have depreciation, for example, on the fund basis, right? It's a non-cash expense. So this doesn't represent cost to purchase good or service. It is an expense because it represents expired during the period. So depreciation is not an expenditure, but an expense. Whereas, for example, when you bought an asset, let's say you went and bought a building, on the fund financial statements, it would be classified as an expenditure because it represents cost to purchase good or service. Whereas on the government-wide financial statements used in accrual basis, that would be represent an asset purchase. So that's the big difference here. And actually on page 75, it says exactly that. Thus, governmental funds report expenditures, not expenses. In the case of employee payroll, utilities, professional travel, and other similar items, expenditures and expenses are essentially the same. In other cases, such as purchase of equipment using governmental fund resources, an expenditure is recorded on an associated fund for the full cost of the equipment, right? As like I said, but for accrual basis, for government-wide financial statements, you'd record an asset. On the modified accrual basis of accounting, depreciation expense is never recorded in the governmental fund financial statements because it does not represent the use of current financial resources. This differs greatly from accrual accounting, where equipment is first recorded as an asset with depreciation expense recognized over the useful life of an equipment. Similarly, now on to other financing uses, such as transfers in the financial sources of one fund to another fund, have the same effect of fund balance as expenditures. Both decrease the fund balance at year end when temporary accounts are closed. So, if you move money from one fund to another fund, that's other financing use would be an example of other financing use. So, other financing sources would be inflows of debt and kind of like transfers essentially of equity. And I'm using equity term loosely here because there's no equity in the government, but essentially moving funds of money from one fund to another. And if you're moving out, that's other financing use. If you're moving funds in from another fund, that's other financing source. Okay. Now we're on to question 3.6. Explain the difference between program revenue and general revenue. Why does the GASB require this distinction? And we kind of already talked about it. Program revenue is the revenue derived through a particular thing the government does. So let's say it charges toll fees for the use of the road, right? So that would be a program revenue. General revenue is something that cannot be allocated to a particular program, really. So the most common example of general revenue would be taxes collected from taxpayers. Why does GASB require this distinction? Because GASB wants to show how different programs are things that different things government does, right? And Medicare would be an example of a program, or maybe help with families with dependent children on a state level might be a program, or educational activities of the government might be a program, right? So you want to give taxpayers, the users of the financial statements, a pretty good sense of how individual programs generate revenues and how they expend money, what sort of expenses that they have. How do budgetary fund balance and fund balance accounts differ? So now we're into budgeting a little bit, budgeting accounting. Of course, budgetary accounts, as you learned in the second part of the chapter, are temporary accounts, right? You need to establish budgets and budgetary accounts because budgets are the way to control how the government, spends its money essentially, and that especially budgets are means of control. Let's say the legislative bodies, whether it's a state legislature, whether it's a city council, or even like that, exercises over the management of the government essentially. Whether it would be the governor or whether it would be the mayor's office or whatever. So, you have the revenues, expenditures, and then you have corresponding revenues and appropriation accounts. And you want to essentially, compare them over time to make sure that in particular, your expenditures don't exceed appropriations. Any government would like revenues to exceed actual revenues exceed estimated revenues. Estimated revenue would be the budgetary equivalent of revenues. Now, if the loosely speaking, revenues minus expenditures plus other financing sources minus other financing uses equals fund balance, then correspondingly, estimated revenues minus appropriations plus other estimated financing sources minus other estimated financing uses equals estimated budgetary fund balance. Now, at the end of every period, budgetary accounts are all closed because you have a new budget. So the biggest difference, therefore, between the budgetary fund balance and the fund balance is the budgetary fund balance at the end of the period is zeroed out. It's closed out. Because you start the new year with an entirely new budget. So you don't want to carry the old budgetary balance over unless there's special provisions in the particular government that they desire that. This question 3.8. For which funds are budgetary comparison schedule statements required? Should the actual revenues to expenditures on the budgetary comparison schedules be reported on a GAAP basis? Why not? Page 78 kind of gives us a nice discussion of that. And the bottom line is you should prepare budgetary accounts for any funds where there is a legislative budget, right? Kind of in the middle of page 78, it says, individual fund budgetary comparisons are required to be presented at the legal level of budgetary control, meaning where the legislature or the city council, whatever else that set the budget for, which represents the administrative level. For example, fund, program, organization unit, which expenditures may not exceed appropriations without a formal budgetary amendment, right? The other thing also to remember that legislative budgets basically say you cannot spend more money, meaning appropriations, than this. But if you need to spend more money than this, then you have to go back to us, the legislative body, and ask for a formal permission, and we'll pass a law or a legislative budgetary amendment allowing you to do that. If you fail to do that, then you're in violation of the law. Meaningful budgetary comparisons also require that the actual amounts of the schedule be reported using government budgetary basis. Some governments, for example, budget their revenues on a cash basis. If the actual column in the budgetary comparison schedule or statement uses non-GAAP budgetary basis, such as the cash basis, either the schedule captions or column heading or the actual amount should so indicate. the bottom line is you need the actual amounts reported compared to budgetary amounts reported should follow. You should compare apples and apples. So if the budgeted accounts follow accrual, then the actual accounts follow accrual. If the budgetary accounts follow cash basis of accounting, then the actual reported amounts for comparison purposes should follow the cash basis of accounting. But further down on page 78, in the very bottom, it says, the GASB standards require that the amounts shown in the actual column of the budgetary comparison schedule conform in all respects with practices used to develop the amounts shown in the budget columns in the schedule, so that there is a true comparison. So we already said that. Standards further require that either on the face of the budgetary comparison schedule or in the separate schedule, the amounts reported in the actual column of the budgetary comparison should be reconciled with GAAP amounts shown in the statement revenues, expenditures, and changes in fund balances. Right. So in other words, if you don't really use what you use in the actuals, if you don't use the basis of accounting consistent with the modified accrual basis, then you need to provide the reconciliation of the actual amounts reported in the statement of, in the budgetary statement to the actual modified accrual basis of account. All right, question 3.9, distinguish among appropriations, expenditures, encumbrances, and expenses. As I already mentioned, appropriations are estimated expenses for budgetary purposes. Expenditures are actual expenditures that the fund spent. Encumbrances are essentially, for budgetary purposes, committed expenditures. So, and you will see that again kind of in federal accounting when we move on to that in the end of the semester. But first, a legislative body appropriates the funds, which basically estimates what the expenditures are going to be. Then the next stage typically is that money, once you know what you want to spend money on, you didn't spend them on yet, but you want to set them aside, meaning the fund wants to set them aside for a particular purpose, that becomes an encumbrance. That's essentially a committed appropriation. Once the money is actually spent, it becomes the expenditure. It moves out of encumbrances into expenditure. So a great example would be, I have it in my work as a faculty member a lot. So for our faculty travel, we are asked every year, like which in the beginning of every year, which academic conferences we're going to go to, for example, and are asked to provide a travel request to estimate the cost of those conferences. Now, I may not go to this conference for like 6-7 months later after the time that I'm requested to provide this information. But the bottom line is when I obviously give an estimate in a form, and that form is used to encumber those funds, to essentially move them, to set them aside, or to designate them, if you will, as likely expenditures. So that way the government could kind of plan and kind of set the money aside in a separate pocket, or, if you will, that this is what we'll actually be spending of the appropriation. So you can think of encumbrances as committed appropriations. That's the other term sometimes is used. Once I actually go on the trip, the money is expended, the expenditure has been booked, and the encumbrance is zeroed out because the money no longer is encumbered, it's been spent. Expenses, of course, are a government-wide financial statement element. Whereas appropriations and encumbrances relate to budgetary accounting, expenditures are to fund accounting, and expenses are talked about, sacrifices of assets or incurrence of liabilities on a GAAP basis pertaining to government-wide financial statements. Finally, question 3.10, what are the allotments and what purpose do allotments serve? You'll see the term allotments also when we talk about federal accounting in the end of our course. And that's the way to kind of control use of appropriations. So it's discussed in the very end of your chapter on page 94. So the reason why allotments exist in particular, and we'll get back to that in the federal space, is that you don't want the government or the agency to right up front spend all appropriations too soon that is given to them by the legislative body, because what will happen if you allow them to do that, it essentially incentivizes bad habits, right? So they'll spend all the money very soon and come back to you, the legislative body, whether it's the local municipal council or the state legislature or United States Congress, say, listen, I've spent all the money, give me more money. And so it kind of creates incentives for non-prudent fiscal behavior. So for that reason, instead of necessarily allow you to use all appropriations up front, some legislative bodies, in particular United States Congress, they have an appropriation, which is the money set aside for the whole year, but they cannot use the whole appropriation at once. So the money is allotted periodically, every quarter, every month, whatever. And that's the part of an allotment is the part of the appropriation given to the government that they can use in a particular period. So they'll use part of it, then in first quarter, then they allotted more of that appropriation. By the end of the period, the budgetary period, the whole allotment is used. The whole appropriation is used because it has been fully allotted. So on pages 94, 95, it talks about how first in particular on page 95, you're given a journal entry to record the budget, where you debit estimated revenues, credit unallotted appropriations, and the difference is the budgetary fund balance. As opposed to, if you don't use allotments, you just have appropriations, not unallotted appropriations. Unallotted appropriations, and over time, as they become allotted, they reverse to allotments, and the allotment is what you can use over time. And then, of course, allotments in the end of the period will be also zeroed out. So it just provides an extra step to control use of appropriations by the government. So that kind of concludes our discussions of discussion of the review questions for chapter 3. Thank you very much for listening.